A friend texted me last spring with what sounded like a simple question. He wanted to know how much money he needed to have invested before he could quit working and live off the dividends forever. He asked it the way you'd ask a calculator a question. Just punch in the number, give me the answer, I'll go figure out how to get there. The math part is genuinely easy. You divide the annual income you want by the dividend yield of your portfolio, and the answer is the capital you need. $50,000 a year divided by a 3.5% yield is $1.43 million. 6% yield, $833,000. 1.5% yield, $3.3 million. The framing you usually see is some version about 4 seconds. But that number, the one the calculator hands you, is roughly 30% of the truth. The other 70% lives in 3 layers underneath it that almost nobody walks through. Layer 1 is taxes. Because the dividend income the calculator gave you is pre-tax, and depending on where you hold the money, the government takes a meaningful slice every single year whether you wanted that income or not. Layer 2 is inflation. Because $50,000 a year today buys roughly $30,000 of stuff in 20 years. And most of the dividend strategies people anchor on aren't structured to keep up. And the third layer, the deepest one, is that the entire framing of living off dividends treats dividends as a different category of return from everything else your portfolio does, when economically they're not. Once you stack those 3 layers, the original question changes. Not, how much do I need to live off dividends, but how much do I need to live off my portfolio, which is a different number and a much better question. That's the video. The basic math, then the 3 layers most people skip, then what actually works in the interest rate environment we're sitting in right now. I'm Tong. This channel is about real personal finance. The kind that works for normal people instead of the kind that gets you to click on a thumbnail. No fluff, no fantasy returns, no get rich quick. If that's what you want, hit subscribe. A quick framing before we start. Nothing in this video is anti-dividend. Dividends are a real part of total return. Dividend-paying stocks are a real part of a real portfolio. And there's a version of dividend investing that works well in retirement. What I'm pushing back on is the version of the dream that treats live off dividends as the goal itself, rather than treating live off my portfolio's total return as the goal, with dividends as one of several inputs. That's the version of the math the calculator can't see. Let's get into it. Start with the formula, because at least the formula is honest. Your target annual income divided by the dividend yield of your portfolio equals the capital you need. $50,000 a year is the number most retirement videos anchor on, so I'll use it too. Now the yields as of June 2026. The S&P 500, the broad US stock market index, is currently yielding about 1.07%. That's the dividend yield of the entire American stock market right now, and it's near a historical low. Run the math at that yield. And to generate $50,000 a year, you'd need a portfolio of about $4.7 million. That number is so large, it should reframe the whole conversation right there. A regular index fund portfolio cannot get you to $50,000 of pure dividend income without an enormous amount of capital, because the broad market just doesn't yield very much right now. The next yield tier is the dividend-focused exchange-traded funds, the STHDs and VIMs of the world, which screen for higher-yielding companies and currently throw off something in the 3 to 3.5% range. Run $50,000 a year through 3.5%, and the capital you'd need is about $1.43 million. That's still a lot of money, but it's now in the realm of an actual middle-class retirement target. The third tier is the high-yield dividend stocks, the ones that pay 5, 6, or 7%. At 6%, you only need about $833,000 to generate $50,000 a year, which sounds great until you spend 10 minutes looking at the companies that yield 6%. A high yield almost never comes from a company doing well. It usually comes from a company whose stock price has dropped enough that the same dollar dividend now looks like a bigger percentage of a smaller share price, which is to say the yield went up because the stock got hurt. And the dividend itself is often the next thing to go. Take Intel as the most recent brand name example. Intel paid a dividend continuously from the early 1990s through the early 2020s, and a lot of people held it as a steady Eddie income stock. In February 2023, Intel cut the quarterly dividend by about 2/3, dropping it from 36.5 cents a share to 12.5. Then in August 2024, the company announced it was suspending the dividend entirely starting the fourth quarter. As of when I'm recording this, Intel still pays zero. Anyone whose retirement plan was built on Intel's quarterly check learned the hard way that high yield and safe are not the same thing, and that the second one is the one that actually matters. So the first layer of the math gives you a range. Somewhere between 800,000 on the chase yield end and almost 5 million on the broad market end, with the realistic middle around 1.5 million. That's the answer the calculator gives you. Now let's start subtracting from it. The framing you usually see is some version of the phantom income problem. The $50,000 of dividends the calculator handed you is a pre-tax number. The post-tax number depends on what kind of account holds the money and what other income you have. If your dividends are qualified, which most dividends from US companies and US listed funds are if you've held the shares long enough, they're taxed at long-term capital gains rates instead of ordinary income rates. The 2026 brackets are 0% on long-term capital gains and qualified dividends up to about $49,000 for a single filer and $98,900 for a married couple filing jointly, 15% in the middle range, and 20% at the top. For a retired couple with no other income beyond Social Security, taking $50,000 of qualified dividends could be entirely federal tax-free because that $50,000 sits inside the 0% bracket. That's the good case, and it's a real one. Couples planning their retirement income around qualified dividends inside taxable accounts can sometimes capture truly tax-free income, which is why the strategy genuinely works for some people. The bad case shows up while you're still working and accumulating. If you're 40 years old, you have a salary, and you're holding dividend stocks inside a regular taxable brokerage account. Every dividend you receive is taxed in the year it lands, whether you wanted that income or not. You didn't sell anything. You didn't take any action. The dividend just showed up, and it's now part of your taxable income for the year, taxed on top of your salary. For someone in the 15% qualified dividend bracket, that's a 15% annual leak on every dollar of dividend income you receive but don't actually need. I call it phantom income because you didn't ask for it, you can't easily turn it off. And it costs you real money in tax even when you'd rather just let the position grow. The implication is that the right home for dividend stocks during accumulation is usually a tax-advantaged account, a 401k, or an IRA or a Roth, where the annual dividend doesn't create a tax bill. Once you're actually drawing the income in retirement, the calculus flips, because then the qualified dividend brackets are doing real work for you. The mistake is holding a high-yield dividend portfolio in a taxable account during your highest earning years, which is exactly when the tax drag is worst. A surprising amount of dividend-focused content skips this entirely. The second hidden layer: inflation, which most dividend math ignores. $50,000 a year today is $50,000 a year today. 20 years from now, at a 2.5% average inflation rate, $50,000 buys about $30,000 of today's stuff. At 3% inflation, closer to $27,500, the number on your check stays the same. The groceries cost more. This is a problem with treating dividend income as a fixed target. If your target is $50,000 of dividend income at age 65 and you actually hit it at 65, you're hitting your target. By age 85, that same $50,000 check is buying somewhere between half and 2/3 of what it bought 20 years earlier, which means your standard of living quietly drops every single year of the retirement that was supposed to feel safe. The fix in dividend investing is supposed to be dividend growth. Companies that raise their dividend every year, ideally at a rate that exceeds inflation, give you income that keeps up with prices. Over long historical periods, the broad US market's dividends have grown at roughly 5 to 7% a year, which is comfortably above the long-run inflation rate. That's the version of the strategy that actually defends purchasing power. The catch is that high yield and high dividend growth tend to be opposites. A company paying 6 or 7% of its share price out in dividends usually doesn't have much cash left to grow the dividend because it's already distributing most of its earnings. The dividend either stays roughly flat or grows slowly. A company paying 1.5 or 2% of its share price out, on the other hand, often grows its dividend at 8, 10, or 12% a year, because most of the cash is being reinvested in the business, and the small dividend is easy to keep raising. So you have a choice. The high-yield strategy gives you a big check today that may grow slowly and may shrink. A dividend growth strategy gives you a smaller check today that's likely to be much bigger in 20 years. Either way, the high-yield now version of live-off dividends is the one that ages worst, because it's the one with the least built-in protection against the only inflation rate any of us will ever face, which is the actual inflation rate the economy gives us. A retirement plan that pays you $50,000 a year forever, in flat nominal dollars, has a real lifespan of maybe 15 good years before it starts pinching. The third hidden layer: dividends are not actually a different thing. Here's the part that genuinely surprises people. From a pure return perspective, there is no economic difference between receiving $1 of dividend and selling $1 of stock. They both reduce the value of your remaining holdings by exactly $1. The dividend pays in cash. The share sale converts a piece of your equity into cash. The total you have, dollars plus remaining stock value, is identical after either move. What this means is that the entire mental category of live off dividends and never touch the principal is a kind of accounting illusion. When a company pays you a dividend, the stock price drops by the dividend amount on the ex-dividend date. Your stock holding is now worth less than it was the day before by the exact amount of the cash you received. You did, in fact, touch the principal. You just touched it through a mechanism that feels different from selling, even though mathematically it's the same move. Run the math on two portfolios with identical starting balances and identical total returns, but different yields. Portfolio 1 is $1 million in a broad index fund yielding 1.2% and growing 5.8% through price appreciation for a 7% total return. Portfolio 2 is $1 million in a dividend-focused fund yielding 4% and growing 3% through price appreciation for the same 7% total return. Both portfolio holders want $40,000 a year in income, which is the standard 4% withdrawal rate. Portfolio 1's owner gets $12,000 in dividends and sells $28,000 worth of shares for $40,000 in cash. The portfolio ends the year worth about $1,030,000. Portfolio 2's owner takes the $40,000 directly in dividends and sells nothing. The portfolio ends the year worth about $1,030,000. Same total return, same income, same ending wealth. The only difference is the route the cash took to get out of the account. The reason this matters is that real-world dividend-focused portfolios usually don't have the same total return as a broad index. They're systematically tilted toward defensive sectors like consumer staples and utilities, and away from the growth sectors that have driven most of the market's return over the last decade. So the comparison isn't usually one and the same total return delivered two ways. It's a higher total return from the broad market versus a lower total return from the dividend tilt, with the dividend tilt's only advantage being that the cash comes out in a form that feels different. Same lifestyle, less total wealth by the end of a 20-year retirement. Once you see this, the live-off dividends framing starts to feel less like a strategy and more like a preference for one shape of withdrawal over another, which is fine as a preference. It just shouldn't drive how the underlying portfolio is built. There's one more piece of the math that matters because of what's happening right now in interest rates, and it changes the entire risk-reward calculation on chasing yield. A high-yield savings account at one of the better online banks is currently paying somewhere between 3.75 and 5% depending on which bank and which day you look. A 10-year U.S. Treasury bond is yielding right around 4.5%. The federal funds rate, which is what banks earn on overnight deposits at the Fed, is in the 3.5 to 3.75 range as of June 2026. Now I ask what a 5% yield on a dividend stock is actually buying you. You're taking equity risk, meaning the stock can drop 30% in a bad year. You're taking company risk, meaning the dividend can be cut or suspended like Intel did, and you're taking sector concentration risk because the high yielders are clustered in a few defensive industries. And in return for all that risk, you're getting a yield that a treasury bond pays you for taking essentially no risk at all. This is a fundamentally different environment than 2021, when treasury yields were near 1%, and dividend stocks look like one of the only ways to get any income at all. In that environment, the risk premium for chasing dividend yield was real. In this environment, it's mostly gone. You can get a 4% yield with FDIC insurance up to the limit just by parking cash at the right online bank. That doesn't mean you should put your whole retirement in a savings account. It does mean that the high-yield dividend stocks, the ones that need to pay 6 or 7% to be interesting, are now competing with risk-free alternatives that pay almost as much. The math doesn't favor them anymore. So what do you actually do if you want income from your portfolio someday and you're trying to think clearly about it? Start with the right question. Not how much do I need to live off dividends, but how much do I need to safely withdraw 4% a year from my portfolio? At $50,000 a year, the answer is $1.25 million. Regardless of whether the cash comes out as dividends or share sales, the total return framing gets you to the same lifestyle with the same capital, and it doesn't lock you into the defensive sector tilt that dividend-only investing imposes. If you're still in your accumulation years, keep dividend-paying positions inside tax-advantaged accounts, not taxable ones, so the annual dividends don't bleed off as tax. Your taxable brokerage is the right home for broad market index funds with low turnover, because those throw off the smallest annual tax bill. If you're closer to retirement and you want some dividend income for the psychological comfort of having checks arrive, hold dividend ETFs as part of the portfolio, not the whole of it. A reasonable split for many retirees ends up being something like 60 to 70% broad market index, 20 to 30% dividend equities, and the rest in bonds or cash depending on age and risk tolerance. The dividend portion provides the steady checks. The broad market portion provides the growth that keeps your purchasing power intact for 30 years. And in this specific 2026 environment, do not ignore that a high-yield savings account or a short-duration treasury is paying close to 4% for genuinely zero risk. Building part of your near-term living expenses out of cash and short-duration treasuries, rather than reaching for yield and dividend stocks, is just better risk-adjusted income right now. That changes once rates drop again, but right now, the risk-free yield is real. My neighbor Paul retired about a decade ago. He drives a Subaru with enough dog hair in it that you could knit a sweater. Paul lives in part on his Social Security and in part on withdrawals from a 3-fund index portfolio he built over 40 years. Of being unremarkable about money? He's never owned a high-yield dividend stock in his life. He doesn't have a ISTHD or a VIM. His broad market index fund yields about 1.5%, and he covers the rest of his spending by selling shares once or twice a year when he needs to refill the cash account he lives out of. Paul has been doing it that way for 10 years. His portfolio is bigger now than the day he retired, even after a decade of withdrawals, because the total return on a broad equity index has been more than enough to fund his lifestyle and grow the balance. He has never once worried about whether a company was going to cut its dividend, because he isn't dependent on any specific company's distribution decisions. He sells what he needs, when he needs it, and the math takes care of itself. That's the version of living off your portfolio that I think most people are actually looking for when they ask the dividend question. The check shows up, the portfolio keeps working. Nothing about the structure depends on the next quarterly board meeting at some company you don't run. It's quieter than the dividend version, and it doesn't make for good content. But it works for a 30-year retirement, and it doesn't require you to outsmart the math on high-yield stocks that almost no one outsmarts. Drop a comment with where you currently sit on the dividend versus total return question, and which of the 3 hidden layers you hadn't really thought about before. I read everyone, and if you want me to walk through the specific 4% withdrawal mechanics, including how to actually structure the cash buffer that makes it work, hit subscribe. That's the next video. I'll see you in the next one.